Before we start this video, do like and subscribe to our channel and not miss on any updates.
So now we'll start with the next standard, which is Accounting Standard 3. This is one more standard where you should target 8 out of 8 or 5 out of 5. Now you might be saying, sir, for every standard you are saying the same thing. 90% of the questions you can get the marks. Okay. Oh, I'm muting. Sorry. Just a second. So welcome back, and now we'll start Accounting Standard 3. Right. This is cash flow statement. This is another standard where you should target 6 out of 6, 5 out of 5, 8 out of 8, whatever comes in the exams. And now you will be saying, sir, for every standard you have been saying the same thing. Now the reason why I'm saying these things is it is possible. 90% of the questions from the standards we have done so far, I don't think you will be losing out marks. And the strategy in the examination should be to identify these questions and solve it first. Don't waste time in new questions, sometimes what happens is difficult questions are tested and you get stuck there. Don't do that. Simpler questions from the standards. So what have we completed so far? We have completed Accounting Standard 2. We are done with 4, 5. This is theory. Here it is slightly difficult to get out of out. Okay. Then 7 is completed. We have completed 9 as well. We have completed 10. We have completed 11, 12. 13 we have not done, 14 we have not done, 15 we have not done, 16 is completed, 17 is pending, 18 is pending, 19 is completed, 20 is also completed, 22 is completed, and 20, yeah, that's all what is completed. Now, in all of these, 90% of the questions that are tested you are familiar with. So our strategy should be, the moment you see a question on Accounting Standard 12, is it familiar? Yes, solve it. If you get a 10, is it familiar? Yes, solve it. 7, familiar? Yes, solve it. So by doing that, what happens is 30 to 35 marks we have kept it in our pocket. Out of 35, if you are able to test or get 25 also, it's a good score. 25 plus our score target of 20 in MCQs, through whatever extra marks you get will be a bonus for you. We have not yet touched upon amalgamation, consolidation, internal reconstruction and financial statements. There also I'll tell you how you can score higher marks. With that, 60 scoring is not tough in advanced accounting. Okay, so that is our objective, and that is what we should follow. Now, coming to Accounting Standard 3, okay, if you have time and if you want to understand the logic of why we do the indirect method the way we do, there is a video on YouTube already available. You can go through that. I will give you the summary of how to approach direct and indirect method in the examination. Right now, Accounting Standard 3 deals with cash flow statement. Basically, what we are doing, most of the times you get a question on indirect method. Basically, what we are doing is P&L, which is prepared based on accrual method, we are converting that to a cash method. That's all what we are doing. That's all we are doing in the logical part of it. There is an accrual P&L given, we have to convert that to cash basis. Right now, when we do that, what we should understand is, first we'll talk about indirect method. I'll come to classification and all of that subsequently, because that is not much relevant for understanding the format of the cash flow. When we follow the indirect method, you have cash flow from operations, right? And this you will start with the net profit that is given to you, and you will arrive at the cash flow from operations. The remaining cash flow from investing and cash flow from financing activity, these are prepared using direct method only. If I draw up a P&L and if I draw up a balance sheet for you, here you have, let us say, sales. Here you have purchases, opening stock, closing stock, salary, depreciation, interest, gain on sale of fixed asset, something like that, investment income and all of those things. In the balance sheet, you have fixed assets, current assets, equity, liability. Okay. Now, you may have investments also. Now, our idea is to first segregate the items between cash flow, operating activities, investing activities, financing activities. Operating activity is the day-to-day activity that the enterprise undertakes to earn revenue. So anything related to day-to-day operations, for example, sale of goods. Sale of goods is my day-to-day activities. Purchase of goods, payment of salaries, all of that are my day-to-day activities which I classify it as operating. And any item related to these purchases, sales, salary, sales, closing stock, opening stock, which are a part of my day-to-day activity, any activity, what you see in any item that you see in the balance sheet, for example, under current assets, you have debtors. Debtors are linked to sales. So if sale is my operating activity, this debtor is also my part of operating activity. Same way purchases, anything here, creditor is a part of my operating activity. Salary I pay, part of my operating activity. Stock, whatever lies here as stock, that also becomes my operating activity. So first, identify operating activities. Okay. Then, what are investment activities? Cash flows related to fixed assets and investments are a part of my investment activity. And if anything is investment is there, from this investment, let us say I have interest income. That interest income is also a part of my investment activity. From this fixed asset, there is a gain on sale of fixed asset. That gain on sale of fixed asset is not my operating activity. It becomes a part of my investing activity. So that is the way you will get the investing activity. So what is financing activity? Activity related to equity and loans is my financing activity. Now I paid interest on the loan. This interest also becomes my financing activity. So first, have a bird eye view of which activities to place where. Which activities to place under operating, investing and financing activity. Then there are some items called like depreciation which are non-cash. Now when it is non-cash item, that does not become a part of my cash flow statement at all. That doesn't become a part of my cash flow statement at all. So the moment you get a P&L and balance sheet, this is the first thing you get. Now in the examination, most of the times you will be given the net profit, or you need to derive the net profit and you have to take care of this balance sheet. A detailed P&L is not given generally in a cash flow statement question. Okay, this is the framework you should be aware of. Now, I will do cash flow from operating activity, a detailed breakup, because this is where maximum trouble comes to the students. You will start from net profit before taxes. You will start from net profit before taxes. If it is after taxes, you will add back the taxes and you will get to the net profit before taxes. Now please understand, when you get this net profit, there are items like depreciation, which is non-cash. There are items like gain on sale of fixed asset, which is not pertaining to operating activity. There are items like interest income and interest expenses, which are not a part of my operating activity. So what do I do? From the net profit, I will add non-cash expenses. So why do I add non-cash expenses? Please understand, for arriving at this net profit, I deducted those expenses. Now, those expenses are not a cash in nature. They are not cash in nature. I have not paid cash. So I will add non-cash expenses like depreciation. Other logic is depreciation is not even a cash flow. So gone. Okay. Then what I will do is I will add or reduce items belonging to other categories. Meaning to say, for example, there is investment income. There is investment income. Now, is this investment income my operating activity part? No. So what will I do? This investment income I will reduce. I will reduce. Why will I reduce? While calculating net profit, I have added investment income, but to calculate cash flow from operations, because it is not a part of my operating activity, I will reduce any investment income, any gain on sale of fixed asset. I will reduce. So this I will say minus. I will add back any expense which belongs to other category. What would that be? Interest expense. Now that interest expense is not a part of my financial, not a part of my operating activity. What will I do? I will add back the expense which belongs to the other category. Okay. Similarly, there could be loss on sale of fixed asset. Is fixed asset belonging to operating activity? No. So if there is any loss, I will add. So why are we adding? For calculating net profit, we would have reduced now this loss to cancel out the impact. We are adding back. So like this, first you will do these adjustments. Okay. Once you do these adjustments, you will arrive at something called as cash flow from operations before working capital changes. Right. Now after this, what happens is I have to give effect of working capital changes. I have to give effect of working capital changes. What is the meaning of that? Simple case. This is my P&L. Here I have recorded sales of 1000. I have recorded sales of 1000. Okay. Here is my customer which has an opening balance of 100. Sales of 1000 I have recorded, assuming entire sales is belonging to this person. Closing balance of 200. Closing balance of 200. Now, how much cash has been received? Cash, if you see, 1000 plus 100, 1100 minus 200, I have received cash of only 900. I have received cash of only 900. But while calculating net profit, I have taken sales of 1000. The sales of 1000 is included in net profit here. Now I have to change, or I have to give the impact so that 1000 can come down to 900. How to do? A simple assumption what you can do is, for all the assets which are current assets, you will take, for all the assets you will do opening minus closing. Remember this for the examination. Sir, how opening minus closing? I gave you a brief logic. Full logic is there in one of the other video where I have explained indirect cash flows. Okay, so you can search that and you can have a look at it. Assets is opening minus closing. Means what? Opening 100, closing 200. 100 minus 200. This is minus 100. Minus 100 happens automatically. From 1000, it came down to 900 because of this minus 100. Similarly, if there is inventory, opening minus closing. Any other current asset, opening minus closing. Done. If there is a liability, you will take closing minus opening. If you want to remember it the other way, what you can think is, opening balance was 100, closing balance is 200, means I have not collected 100 rupees. Same way for liabilities, closing minus opening you will do. Whatever is the outcome, plus or minus, you will do it accordingly. When you do this, after you calculate effect of working capital changes, you will get cash flow from operations before taxes minus taxes paid. You will get cash flow from operating activity. Okay, this is one thing. If you practice 2-3 questions in the pattern that I have suggested, then cash flow statement is also out of your problem box. There may be some nitty-gritties in adjustments. When we take up some questions, we will handle that. No need to worry. But tell me, at a conceptual level, are you clear with cash flow from operating activities? How do we broadly calculate in the indirect method? Direct method I will not put a lot of focus on, because direct method is simpler. Direct method is actually simpler. It is more about mathematical ability than actually understanding the flow. Any questions on cash flow from format of cash flow from operating activity? Of course, as I told you, when we take up questions, we'll have more clarity. Great. No questions? Nice. Now, after we have calculated cash flow from operating activities, the remaining two which are left is cash flow from investment and cash flow from financing activity. cash flow from investment basically have purchases of fixed asset or investments as a negative number, sale of fixed asset or investment as a positive number. Now here what you have to understand is, sale of fixed asset, when it comes to P&L, here you will have gain on sale of fixed asset. Gain on sale of fixed asset may be 100, but here you have to take actual sale proceeds, maybe 1000. Whatever is the actual sale proceeds, you will give it as a positive number. Whatever is a outflow, purchases, you will give a negative number. Same way for financing activity, proceeds from equity, preference, loan, you will give a positive number. Whenever there is a redemption, you will give a negative number. Then if there is interest paid, dividend paid, all of that is a negative. Right? Then taxes impact, if there is a tax impact which is given for interest not paid actually, tax impact given for, let us say, interest received. You have earned interest income on investment and there is a tax impact, that will form a part of cash flow from investment activity. Okay, so they'll give things like TDS and all of that. It will be a part of cash flow from investment activity. So what you need to understand is, where is the source going to? Where is the item in the balance sheet going to? Investment goes to cash flow from investment activity. If investment goes to cash flow from investment activity, then related interest also should go to cash flow from investment activity. Related TDS should also go to cash flow from investment activity. So sometimes if you are lucky, you will get a question on classify the following items as investment, operating or financing activity. 8 or 9 points or 10 points they would give. Do it blindly. Even if you make 8 right, 9 right, 7 right, 6 right, bonus marks directly you can score, no problem at all. Okay. Then this you will compare with opening cash and you will get something called as closing cash. I have done a quick recap of how you should approach a cash flow from operating, investing and financing activity using indirect method. Direct method, I'll come to it subsequently when we start looking at the theory. Classification also I have covered broadly. Now having understood this, let us go back. We need to understand few definitions. First is cash and cash equivalents. What is cash? Cash is cash in hand, physical cash in hand. Demand deposit with bank. Demand deposit means the type of deposit which you can demand from the bank anytime you want and the bank has to give you. For example, if I have a savings account or if I have a current account, I go to the bank and say, I need to withdraw entire money. Bank cannot say, I will not give you. It has to give me back. That is called demand deposit. So cash includes cash in hand and demand deposit with bank. Now this demand deposit, you have to differentiate this with fixed deposit. Fixed deposit is there for a fixed tenure. Fixed deposit is there for a fixed tenure. Sir, but we can go to the bank and we can ask any time that we want to break our FD. You can ask, but for that you have to pay a penalty. Okay, that is why it is not included as a part of cash. Then what are cash equivalent? Cash equivalent, remember this definition. Short term here we refer to a period of 3 months. Highly liquid investment. Highly liquid investment means you can sell it whenever you want to and you can realize cash. That are readily convertible into known amount of cash. So for example, I have a 2 months FD. I gave 10,000 rupees for a 2-month FD at 7%. It is highly liquid. I can redeem it within 3 months period. I know I will get 7%. That amount is also fixed, which are subject to insignificant risk of changes in value. Means what? 7% is known. Even if I go after 1 month, if they want to deduct penalty, I'll get 6%, but the risk is very less. Whereas if I invest in something called equity shares, there is a high risk. So investment in equity shares is not cash equivalent. So when I say cash equivalent, it is something like I have cash, it is almost equal to cash. It is almost equal to cash, and I know how much of cash will I receive when I actually go out and redeem that particular investment, right? So short-term, highly liquid investment that are readily convertible into known amount of cash and which are subject to insignificant risk of changes in value. Generally, securities with short period of less than 3 months are considered. Also, we take preference shares bought near maturity. But please understand, you have to consider on date of purchase. Means, let us say I am on 1st of December. I have taken 6 months FD. So this 6 months FD will mature on which date? 31st of May. When I purchased, it was 6 months. So this is not a cash equivalent. Don't say that on 31st of March, only 2 months are pending. So now I will consider it to be a cash equivalent. No, you have to classify it on the date of acquisition. Okay. So cash in cash equivalents, cash in hand, demand deposit with bank, short-term highly liquid investment which can be converted into known amount of cash and which have insignificant risk of value changes. Okay, these are cash and cash equivalents. From the balance sheet, this part will be excluded and it will be presented as a reconciliation item. Here, cash and cash equivalents in the beginning of the year, cash and cash equivalents at the end of the year. This difference will be total to this difference. Then, activities of cash flows are classified as operating cash flows, investing cash flows, and financing cash flows. What are operating cash flows? These are generated by operating activities, that is principal revenue producing activities. Purchase of goods, payment to suppliers, receipts from customers, payment of salaries, anything related to day-to-day operations. And one more rule is that if you cannot classify something into investing or financing, you will classify that under operating. Okay, that is the first thing. Then, what is investing activities? These are acquisition and disposal of long-term assets and other investments not included in cash equivalent. So if there is a short-term FD, cash equivalent. If it is a 6 months FD, then it becomes an investment activity. Okay. Then these are financing activities that result in change in size and composition of the owner's capital and borrowing of the enterprise. So collection of shares proceeds, redemption of shares, repayment of loan, taking of loan, all of that come under financing cash flows. We prepare using two, indirect and direct. Direct is more simpler. Indirect is where we tend to get complicated, confused. So this, we have already discussed. You can have a look at this example subsequently. Under indirect method, as we have already discussed, we will be quickly recapping the format. Okay. First, cash flow from operating activities. When we calculate, we take net profit for the year, generally before taxes. If it is after taxes, you will add back taxes. Add all non-cash and non-operating expenses, less non-cash and non-operating incomes. This gives us operating profit before working capital changes. Okay. Now, from this, you will take decrease in current assets and increase in current liabilities. The technique to remember that is closing minus opening. Sorry. You will take opening minus closing for assets and closing minus opening for liability. If opening minus closing is positive, means what? Closing is opening minus closing, if it is positive, means what? Opening is more, closing is less. That is, it is decreased. So you will add. This is a better way to remember for the examination. This gives us cash generated from operations. You will reduce income tax and you will get cash flow from operating activities. From investing, which you have already considered, discussed, then you will take financing. Sum of all of these three will give us cash flow from operating, investing and financing activities. You will take cash and cash equivalents at the beginning of the year, add it to the difference, and then you will get the ending cash and cash equivalents. Okay. Now, Sometimes you have loans and advances and interest earned on loans and advances. If my business is to give loan and take loans, taking loan and giving up loans, then this becomes my operating cash flow. Otherwise, it becomes my investment cash flows. Then, if you are giving advances to employees or creditors, if you are giving advances to employees or creditors, this is a part of your operating activities. If you charge interest from employees, so I am in a business of, let's say I am in a business of manufacture of goods. I have some employees. I have given loans to my employees. I've given loans to my employees and I've collected interest from them. That is also part of my operating activities. For extraordinary cash flows, we need separate disclosures under each: operating, investing, and financing activities. Okay, for example, insurance claim received against loss of stock is an extraordinary operating cash flow. Okay, so that is what you have to disclose separately. This we have already discussed, interest and dividends. So if interest and dividends are received from your investments, it is a investing cash flow. If interest and dividends are paid, it is a part of your financing cash flow. But if it is a financial enterprise, that becomes a part of your operating cash flow. Okay, now as far as exchange gains or losses are concerned, what you just need to remember here is the cash and cash equivalents as per the cash flow statement, and that recognized in the balance sheet is recognized as a note to the cash flow statement. So basically what happens is, let us say I have cash equivalent USD 100. I'll convert this into INR 100 into 85 and I'll present 8500 in the balance sheet. If there is any difference in the amounts because of the cash flow and the ending balance recognized, that will be a part of exchange gain or loss. Don't waste too much of time here. Okay, just the question that it has to be reconciled. That is what you have to be reporting. Now you might be sometimes wondering that, so what to do with the gains or losses which is recognized in the P&L, which is added to the debtors balance, added to the creditors balance. All of that is taken care when you calculate working capital changes. So no need to worry about that. Can I report cash flows on a net basis? Yes, it can be presented for specific cases only. So generally, netting of receipts and payments from investing and financing activities is not allowed under Accounting Standard 3. For example, cash paid on purchase of fixed asset should not be shown as a net amount after deducting cash realized from sale of fixed asset. But netting is permitted for financial enterprise and for investment companies. For example, for financial enterprise like bank, customer deposits, customer withdraws money, deposits, withdraw money. So instead of showing it on a gross basis, cash flows on acceptance and repayment of deposits with a fixed maturity date, cash flows on placement and withdrawal of deposits from other enterprise, or advances and loans and repayments received from them, this can be shown on a net basis. Same way, receipts and payments for items which turnover is quick, amount are large and maturities are so short, purchase and sale of investment can be shown on a net basis. This can be an MCQ question in the examination. What is the exception for financial enterprise and what is the exception for investment companies? Any questions so far? Okay. So we'll end now. We'll do this illustration tomorrow properly for both indirect method and direct method, which will give a comprehensive understanding, and then we will discuss some peculiar adjustments that keeps on coming in the examination. That will help us properly understand how to handle these type of questions in the examination. Okay, so we'll continue tomorrow. I thought I'll stretch it, but I don't think I'll be able to do justice in the next 20 minutes because we need to have a thorough understanding of the question, how to approach. Okay, so we'll continue tomorrow. Tomorrow most likely we'll do 10 to 12:30 and we'll complete AS3 and we'll start Accounting Standard 29. Okay, so thanks a lot. So we'll take up this question, illustration number 5 of our notes, where we'll do it in both direct method and indirect method. And before I take this illustration, I'll tell you 3 types of questions which are generally tested in the examination. And if you're comfortable with these category of questions, cash flow statement should not be a challenge, right? So direct method is one specific category, right? Other than direct method, one case could be where they directly give you net profit or they will give you the P&L itself. So this is directly given to you, and from this Along with this, you have balance sheet information, and from this you will prepare the cash flow. Second category is they will give you only balance sheet of 2 years. They will not give you P&L, or they will not tell you what is the net profit for the period or for the year. They will only give you the balance sheet. Now, when they just give you the balance sheet, what you need to do is you need to look at the reserves section. In reserves, we have P&L account. Reserves, we have general reserve. We may have, let us say, debenture redemption reserve. We may have revaluation reserve. You have to look at all of these reserves, and we need to prepare ledgers of these to arrive at the P&L earned during the period. So that is one more category which is generally tested. And one more style of testing, especially in the direct method, is they will give you list of information. They will give you list of information. List of information means the company sells so much in cash, so much in credit, then they purchase this, they sold this, like that. They will give you 10 to 15 line items or statements. Using those line items or statements, you have to prepare the cash flow statement, right? Students face a lot of challenge when this is given. When only the balance sheet is given, students generally tend to get stuck in figuring out what is the number or what is the profit for the period. Now, good thing about the questions on cash flow statement is that, for example, in this particular question, if I just show you the solution for, let us say, indirect method, the good thing about cash flow is even if you get this wrong, for example, you should not be getting it wrong, but even if you get this wrong, but if you are able to do this correctly, now this I gave you the formula already. For assets, it is opening minus closing. For liabilities, it is closing minus opening. If you are able to do this, at least for these 5-6 items, you can score marks. At least for these 4-5 items, you can score marks. So what you need to do is, if you get a question on cash flow in the examination, you should not leave it, right? Now, with this understanding, let us come to the question. Here we have statement of P&L and the balance sheet information. Now they have given us the balance sheet information, not the full balance sheet. They have revenue, so sales, you have interest, you have stock adjustment, you have total revenue 4270, then you have purchases, wages, other expenses, interest, depreciation, total expenditure, profit before tax, tax provision, profit after tax. Then balance of profit and loss account brought forward. This is previous year balance. Profit available for distribution, total. Appropriation, they have transferred 200 to general reserve. Proposed dividend 300, means this is the part related to dividend. Dividend distribution tax 30, no longer relevant, but sometimes they can ask as well. Total appropriation 530, balance is 30. Then they have trade receivables, inventories, trade payables, wages, outstanding expenses. All of these are your part of working capital changes. Then they have advance tax and tax provision, 195, 180, 200, 180, opening balance, closing balance. Tax related, I will give you how to do the working note. You can follow that blindly and you can do it in the examination, right? Now we are required to prepare cash flow from operating activities using direct and indirect. First we will do indirect method. For indirect method, I have told you that we should start from profit before tax for the year, that is 710. If you have profit after tax, you will add back the provision for tax and come to profit before tax. Please keep this thing in mind, right? So we will start with profit before taxation of 710. So this number comes from your P&L here. Now, first thing, after you start or after you arrive at profit before tax, you have to go to the P&L and figure out, are there any non-cash expense or non-cash income. Non-cash income would be rare, okay, but most of the times you will have non-cash expenses. In this case, it is depreciation, 100, you will add back. Why did we add? Expenses we had deducted earlier, now we will add back. If it is any income adjustment, we will deduct it. Okay, so that is the first thing. Then here you have interest and dividend. Now this interest and dividend is my income. but this is cash flow from investing activities. So what should I do? I should take it to cash flow from investing activities. Okay, sir, can we consider this interest is from the customer and consider it to be operating activity? Don't overthink. Unless they have mentioned in the examination that it is interest received from the customer, you will assume that this interest and dividend is a part of your investment activity only, especially when dividend is given. Okay, so don't over assume in the examination. Then here you have this interest. This you will assume, unless it is mentioned specifically, we will assume that this is pertaining to financing activity. Now expense I will add back, income I will reduce. So here add back expense, reduce income, so you get operating profit before working capital changes, that is 770. Okay, this is a simple adjustment. Then this one you should be able to do blindly without any trouble. You should be able to do blindly with my formula. So coming back, assets, trade receivable asset, you will do opening minus closing. Opening minus closing. Now be careful with the dates. Sometimes they will give opening here, closing here. So you have to read carefully. Opening is here, closing is here. 250 minus 400. 250 minus 400 is equal to minus 150. 250 to 400 increase. So there is an increase in trade receivable minus 150. Increase in trade receivable minus 150. Then inventories 180 to 200. Again there is an increase. Opening minus closing minus 20. If this was not given, you could have taken that from here also. Okay, the stock adjustment is basically changes in inventory. Then trade payables, liability, closing minus opening. Closing 250, opening 230 plus 20. Increase in trade payable plus 20. Like that, outstanding expense, outstanding wages, all of that you will do the adjustment. You get cash flow from operating activities 640. Then we have this taxes paid, where a lot of us actually get stuck. Okay, so how do we handle tax payable? Simple thing, I'll give you two ways. One is preparation of advanced tax account and preparation of provision for tax account. If at all you get stuck, you prepare a combined account, that will solve the problem. Okay, now here what has happened is, let us see this. You understand the flow first, okay, then I'll give you the shortcut. Now as per this, what has happened here is, you have an advanced tax account and you have tax provision account or assessed tax liability, right? So you have advanced tax account. Advanced tax means we have paid the tax, so it will have a debit balance. Okay, so advanced tax balance brought down is 180. To balance brought down is 180. Okay, balance brought down is 180. Then we have provision for tax. This is a credit balance. By balance brought down 180. Now what happens is, during the period you will use this 180 to settle this provision. So what you will do, you will transfer this to this account. So you will have by provision for taxation 180, here to advanced tax 180. So with this what happens is, this account gets closed. Then in the subsequent period or for the current period, you have 200 of liability which is created. So in the provision for tax account you will have by P&L 200, and in advanced tax you have closing balance by balance carried down of 195. Now this 195 balance carried down, the balancing figure will come from to bank account 195, which means we have paid 195 of taxes. So provision for tax opening balance gets closed with this 180, and current year 200 is my closing balance here. In advanced tax account, the closing balance is 195, that is paid through bank. Okay, that is one way to do. Other way to understand that is, you have advanced tax 180, you have advanced tax 180. This 180 is used to close this 180, and in the current period whatever we paid 195, that is our fresh payment. That is also one another way to understand how it is done. Or what you can do is, you can prepare a combined account, advanced tax plus provision account, where you can say by balance provision 180, advance tax to balance 180. Then in the current period, you have by P&L, how much? 195. Then you have, sorry, by P&L you have 200. Then you have closing balance of advance tax to balance carried down 195, and you have this balance. Oh, did a mistake here. Just a second. I'll do it in a slightly spacious place. It is getting too clumsy. So maybe I'll put it down to notability. It will be easier for you. Okay, so what we'll do is we'll combine advance tax plus provision for tax account. Advance tax opening balance is debit to balance brought down. This is for advance tax 180 by balance brought down 180. This is for provision for taxes. Then we have closing balances for advance tax by balance carried down 195 advance tax to balance carried down 200. This is provision. Then when we create a provision, we would say by P&L 200. Right. Now if you do all the calculations, here you can see this 180 and 180 gets knocked off, this 195, sorry, this 200 and this 200 gets knocked off. So we are left with 195 to bank 195 balancing figure. Now you might say, sir, why so much complications? Directly can we not take 195 closing balance? You should not take directly, because in this case the numbers are matching, but in some other case the numbers may not match. Maybe you have a different balance brought down 180, you have different balance brought down for advance taxes, right? So it is always better to prepare a ledger, at least for your checking, to do the calculations. Okay, so that is one more way in which you can use it to calculate. Or shortcut for cross checking, opening provision 180 minus advance tax 180, so this becomes 0 directly. Okay, so once this has become 0, whatever is there in the advance tax account 195, that becomes the taxes paid during the period. So there are multiple ways to cross check. If you prepare a combined account, you can directly do the cross checking. So 195 is the taxes paid, 195 is the taxes paid, and then you get cash generated from operations 445. So the ledger, what you're saying was provision for tax account and advance tax account, opening balance, sorry, I think it is written ulta. 180 has to be the opening balance and 200 has to be the, this is balance brought down, this is balance carried down. Okay, so 180 is the opening balance, plot the opening balance of advance tax, transfer this to provision for tax, this goes here. Current period, whatever has been charged by P&L is 200, that becomes a closing balance, and here whatever is the balance carried down, the balancing figure becomes through time. Okay, so practice this if at all you are confused. Now this solves the cash flow from operations using the indirect method. Now coming to direct method, in direct method what happens is it is a summary of cash flow or summary of cash book, I would say, where you will take the receipts from the customer, payments to the supplier, whatever has happened, you will take the payments and receipts and prepare the cash flow statement. Now how to do this? Especially when P&L is given, the way you should approach this is, when P&L is given, the way you should approach is sales, this is operating activity. Interest and dividend is a investment activity, ignore it. Okay, stock adjustment does not result in any cash flow as such, so you'll ignore that. Then purchases is an operating activity. This also is a part of operating, by the way. Wages and salary, operating. Other expenses, operating. Interest you will ignore. Depreciation you will ignore. Provision for tax you will ignore. Why? Because you will take directly the taxes paid. Okay. Then after that there is nothing related to your cash flow from operations. Now when it comes to revenue 4150, what is the related item to revenue? Revenue is related to your trade receivables. So what you will do, you will prepare whatever items are given here. you will prepare a trade receivable account. To balance brought down, you will plot 250. By balance carried down, you will plot 400. Sales made during the year, you will post it to the debit side of trade receivable account. Basic ledger preparation. So the way you will do is working note. So this is related to your sales and cash collections. Okay. Now trade receivable, you have opening balance 250 from the information, closing balance 400. These two you will plot. Then to sales you will plot 4150. Sometimes be careful, the question will mention that 80% of sales are made for cash, or sorry, 80% of sales are made for credit. In that case, here you will take only 80%, remaining 20% you will directly take in the cash flow statement, right? So whatever is the balancing figure, this is your cash collected. Same way for trade payables, balance brought down, balance carried down, purchases. Where do we get the purchases number? Purchases you will get from here. Purchases is given directly. If purchases is not given directly, then you have to derive what is the purchases by using the formula opening stock plus purchases minus closing stock is equal to cost of goods sold. You will use this formula to determine what is the purchases. Okay. So as per the information that is available in the question, we will do the working accordingly, right? Then this is done. Wages and salaries, other expenses. Now trade receivable part is done, trade payable part is done, outstanding wages is given and outstanding expenses are also given. So again here you will prepare opening balance 40, closing balance 50 and expenses for wages and salary it is 800. So you will prepare again the ledger, wages payable, opening balance, closing balance, wages payable, balancing figure is through bank. Like that you will prepare for wages payable, then you have outstanding expenses. Again for this opening balance is given, closing balance is given and expenses are given of 200. So this also will prepare a ledger by balance brought down 10 to balance carried down 20. This is the provision for outstanding expenses. Okay, then expenses by expenses for the period 200. So 200 plus 10, 210, 210 minus 20, 190. So you plot 190 as payable. This is one way to do in the ledger format. If you don't want to do in the ledger format, what you can do is for expenses, if you don't want to do in the ledger format, what you can do is you can say cash paid. How do we derive? So you have, let us say, wages, other expenses, trade payables, right? So you can, what you can do for all of this, you can have, or let me put it on the header here, trade payable, wages, other expenses. What you can do is you can say what is the opening balance. Okay, so let us say opening balance of trade payable is 230, 40 and 10. 230, 40 and 10. Then what is the closing balance? 250, 50, 20. 250, 20, 20. Sorry, 250, 50, 20. 250, 50, 20. What is the expense? Expense will get from P&L. Purchases 2400, 800 and 200. 2400, 800 and 200. 2400, 800 and 200. Now how do we get the cash paid? simply whatever is the opening balance plus expenses minus closing balance. Okay, opening balance plus expenses minus closing balance will give you cash paid. 230 plus 2400 minus 250, if I do, I get 2380. That is the cash paid. Is it matching with the number? 2380. Same way, 40 plus 800 minus 50, 790. 10 plus 200 minus 20, 190. So like this, if you want, you can prepare a statement format like this and do the calculation. That is also possible, that is also allowed, right? Any question in preparation of these working notes? I'll just charge this pencil. I don't know why it get charged. Any question on the working notes that we have done for operating? See, we have still investment activities and financing activities where there are some typical working notes, but this is a basic working note format. You all should be thorough with. You have done this in foundation also. You have done this when you prepare those income and expenditure account, receipts and payment account. Same logic is what is being applied. And whenever if you are getting stuck, the best way is to prepare a ledger, because ledger will tell you, or when you prepare the ledger, you actually have clarity as to how the numbers are flowing. Okay, or the statement that I prepared just now, which I showed it to you, that is also perfectly fine. Okay, then you can just put down in the format cash collection from trade receivables, payables, wages, expenses, cash generated from operations before taxes. Taxes paid we have already calculated. Cash generated is 445. Now this is only for operating activity. Sir, could you elaborate on the adjustment when advance tax and provision values are not matching? Okay, so we will take one example and do that as well. Provision for tax opening, closing 180, 200. Advance tax opening 200, closing let us say 190. This could also be a scenario. Okay. Now in the previous question, we directly took the closing balance and we could have done it, but here we have provision opening, provision closing, and we have advance tax 200, advance tax 190. How to do it, right? How to do it. So now what you need to understand is, and okay, one more thing, provision in P&L is again your 200, this number that has come as closing balance, right? Now how to do this? One is you will prepare provision for taxation account. In the provision for taxation account, you have by balance brought down 180, to balance carried down we have 200. Okay, balance carried down is 200. Then what do we have? We have for the current period expense to be 200. So if the expense in the current period is 200, you would say by P&L 200, right? Now how will we close this provision for tax account? The appropriate amount required to settle this provision we will transfer from advance tax account. So you will say to advance tax account 180. Whatever is needed to close this opening provision, you will plot it here. So this account is closed. Now what you will do? You will prepare advance tax account where you have to balance brought down 200 by provision for tax. How much did we use out of this 200? 180. So 180 is transferred to this particular account. Then by balance carried down. What is the balance carried down number? Balance carried down number of this advance tax is 190. 190. So how much did we pay through bank? If you see 200 minus 180, 20 plus 190, 210 is what we have paid. So here the number in the cash flow statement will be 210. Now the easy way for you to remember this in the examination for cross-checking purpose, you can take the closing balance of advance tax. You can take the closing balance of advance tax and whatever is the difference in the opening balance, and you can adjust it accordingly. For example, Oh, I did it ulta. I highlighted it opposite. Just a second. What you can do is, you can take whatever is the closing balance, that is 190 of advance tax, that is the closing balance, and from the opening balance we needed only 180, we had a thing of 200, so that 20 extra you can add it here. So that way also you can do. So amount paid through bank is 200. No, I did a mistake here, guys. You have to correct me. It cannot be 210, no? 200 minus 180. I did it ulta, so it is minus 20, 190. It has to be 170. You have to correct me. I am doing mistake on the face of it, and I am trying to, when I was checking this is when I got to know. So 170 is what is paid through the bank. So how do we adjust that? What you can do is, in the opening 180 to 200, I have 20 extra here, and closing is 190. So 20 extra from here minus 190, I get 170 as the closing balance. Okay, I am repeating again. Sorry for my error in calculation. You can also get confused. So I am repeating this example once again. Provision for tax, opening, closing, 180, 200, advance tax 200, 190. Okay, this is what we have taken, right? I did a calculation mistake, so I am doing it once again. Provision for taxation, you have by balance brought down 180 to balance carried down 200. This 200 comes from P&L, so you will say by P&L 200, and to close this at 180 to advance tax 180. Now coming to advance tax account, opening balance is 200, to balance brought down 200, by balance carried down 190, right? Now out of this 200 we have transferred to provision for taxation account 180. So 200, 180, here it is 200 minus 180, 20, 190 minus 20, 170 is what is paid through bank. So advance tax paid is 170. You can combine both these ledgers and do, you will get 170 itself. And if you want to cross check, what you can say is, my opening provision is 180, I have cumulative balance of 200, out of this 200 I have used 180 here, so I am left with 20. Now to make this 20 190, I need 170. So this is what is tax paid for the period. Is this clear? All of you, is it clear? So in the exams we cannot directly take closing balance. So what you can do for simplicity, opening provision minus advance tax plus closing advance tax. So opening provision 180 minus advance tax 200 plus closing advance tax 190, this is 170. This also can be done. Others, is it clear? Okay, perfect. Right? So this is one category of question where you have to calculate cash flow from operating activities using indirect method. As I told you, for investing and financing activity, it is only a direct method. Right? This is second category of question where they give you list of information and you are required to calculate the cash flow generated during the period. So it says prepare cash flow statement of MNT for the year ended 31st March in year 1 with the help of the following information. Right? Now sometimes we have a question, sir, how do we know whether we need to follow here direct method or can we do indirect method also? So for that you have to see, have they given net profit and working capital changes? If net profit is given, you can do using indirect method if you have the full information of working capital changes. If you do not have full information of working capital changes, then it is better to follow direct method. For direct method, we need cash collection information and cash paid information. Now here, have patience in the examination to read the question slowly, understand whatever is given in the question and then jump to the solution, because you may have linkages between one and other point. Okay, so here first point says company sold goods for cash only. Okay, if it said company sold goods for cash and credit, 80% cash, 20% credit, then that 20% credit information will be used to prepare a debtor account. Okay, then gross profit ratio was 30% for the year. Gross profit amounts to 3,82,500. Now what to do with this information? Gross profit ratio or gross profit is equal to gross profit ratio multiplied by sales. Gross profit is 382,500, which is equal to 30% of sales. So sales is equal to 382,500 divided by 0.3. 30% is 0.3. So like this, by doing this, we will get to know sales number. Whatever number we got here, 382,500 divided by 0.3, 12,75,000. So cash collected from customers 12,75,000, and please ensure to have your working note done. Without working note, marks will not be given. Okay, the first thing. Then, so this part is done, this part is done. Opening inventory was less than closing inventory by 35,000. We'll see how to use that information. Wages paid during the year 490 to 500. They have directly said wages paid. So you can pick that number and you can say wages paid 490 to 500. Sir, can we write wages paid first, trade payables next? Yes, you can definitely do. There is no harm in that. Okay. If they had said wages during the year is 490 to 500, then we had to check if there is any outstanding wages, is there any opening outstanding wages, and then we calculate what is the wages paid, right? Then office and selling expenses paid during the year 75,000. Directly they have given 75,000. Then dividend paid during the year 30,000, including dividend distribution tax. If this number is given, dividend paid during the year, which is 30,000. Paid means already paid. This is your financing activity. So cash flow from financing activity 30,000. Okay. Then bank loan repaid during the year 2,15,000, including interest of 15,000. This is also financing activity. Repaid means negative number. 2,15,000 including interest. So what you will do? You will split that. Bank loan repayment 2 lakhs, interest on loan 15,000. Okay. Now in exam, what you can do is you can leave some sections. Cash flow from, for example, for operating activities, you can leave half a page. Second half, you can leave it for investing activity, and in the next page, you can do the financing activity. So that as and when you get an information in the question, you can pick up the information and plot it at its respective place. Then trade payables on 31st March year 0 exceeded the balance on 31st March year 1 by 25,000. Now here they have given one information. Trade payables related information has been given here. And we also had information of opening inventory less than closing inventory. Now why are these related is because this will help us to get to know what is the purchases, and using that we can use this information here. Amount paid to trade payables during the year is 460. Now see, they gave this information here, but they directly said amount paid to trade payable is 460. Then what will I do? I can directly take that 460 and plot it here. Can directly take that 460 and plot it there. Okay. Then tax paid during the year amounts to 65,000. Provision is not relevant. Directly you can take 65,000 there. So you will directly take 65,000 here. So this is cash generated from operation before taxes, 247,500 minus taxes, net cash generated. Okay. Then investment of 7 lakhs sold during the year at a profit of 20,000. Now for financing activities and investment activities, gross amount is what is relevant. Sold 7 lakhs was sold at a profit of 20,000. So we need to calculate how much of money we received. What is the money we received? 7 lakh plus 20,000. 7 lakhs 20,000 is what we have received. So sale of investment 7 lakh 20,000. Then depreciation on fixed asset not relevant. Plant and machinery purchased on 15th of November 2,50,000. So 2,50,000, that is directly purchased. You can put it. Then you can use cash and cash equivalent and you can solve it. Okay, so nothing complicated, straightforward question. Okay, same way, similar lines, you have illustration number 7. I want you to practice this on your own as a homework. Okay, because if I explain, you will find it easier. Or we can do it. So that should not be the approach. Practice this on your own because there is some information which I credit is so much, cash is so much. So basically, just to give you an example, 135 crores, 60% was cash. So 135 into 60% is cash into 40% is credit. This credit you will use it to create or prepare your debtors account. Okay, so that is how you will do. So if you see the working note here, debtors account, sales 54 that we got, 60% of 135, 81 is cash, credit sale is 54, then you will prepare the debtors account. Same way you will prepare the creditors account. Okay, and some typical adjustment here you can see. Company redeemed debentures of 20 crores at a premium of 10%. Debenture holders were issued equity shares of 15 crores towards redemption and balance was paid in cash. Debenture interest paid during the year was 1.5. So debenture interest paid is a direct outflow. Here what they are saying is debentures of 20 crores at a premium of 10%. So 20 plus 10% if I do, it becomes 22. Out of 22, 15 crores was equity shares. We gave equity shares of 15 crores. So minus 15. How much is paid in cash? 7 is paid in cash. So you can directly say redemption of debentures 7 paid in cash. Interest paid 1.5 is directly given. Okay. Then 8 crores was paid for income tax directly given. Investment costing 12 was sold for 2.4 crores profit. 12 plus 2.4 directly. A new plant costing 21 crores was purchased in part exchange of an old plant. Book value of the old plant was 12 crores, but the vendor took over the old plant at a value of 10 crores. Balance was paid in cash. So what has happened? We purchased a new plant for 21 crores. We gave something in exchange for 10 crores minus 10 crores. So how much cash did we pay? We paid 11 crores in cash. So payment of fixed asset 11 crores in cash, right? So like that you can solve it on your own. Now let us look at this question, illustration number 8, where we have a typical adjustment of machinery. So we'll do that and prepare the cash flow statement. From the following balance sheets of Mr. Zen, prepare a cash flow statement as per AS3 for the year ended 31st March. So opening is given first, closing is given next. Capital account 10 lakhs and 12 lakh 24,000. This means this represents owner's capital. Right, now if there is no other information, we can directly assume whatever has been the increase, that is on account of profit. But if there is other information, we have to ensure or you have to factor in that information. I will give that adjustment as well. Trade payables are then loan from bank. Then you have land, plant and machinery, inventory, trade receivable. This is the most important adjustment in this question. Okay, first, a machine costing rupees 80,000, accumulated depreciation 24,000 was sold for 40,000. The provision for depreciation on 1st of April was 2 lakhs and on 31st March was 3,20,000. Net profit for the year ended 31st March 21 was 360. Okay, so this entire movement is not net profit. You can see net profit is 360 and here there is a different amount. So the balancing figure will be something else which we need to figure out, right? Then this machine part we need to figure out. What has happened? Machine costing 80,000 having accumulated depreciation of 24,000 was sold for 40. So this 40,000 is my cash flow from investment activity. That is very clear. But I would have recorded the profit on sale of machinery in my P&L. I need to know what is that amount and make the adjustment accordingly. Then I also need to check because there is a movement 640 to 880, is there any other purchase of machinery that also needs to be figured out? Okay, so that is how we have to work this out. Whenever you have information on accumulated depreciation like opening balance 2 lakhs and closing balance 3,20,000, we have to calculate gross block and accumulated depreciation separately and understand whether there has been any further purchase of machinery. So what do we do is WDV closing balance 640 and 8,80,000 is given. That is directly given. Because we have information on accumulated depreciation, you will add back 2 lakhs to 3,20,000. So the gross block becomes 840 to 12 lakhs. Can I say this directly is the purchase value? Again, because there is a sale transaction, we need to prepare the ledger. So first thing what you will do is, you will compute the gross block. You will compute the gross block of machinery if you have the information. After you prepare the gross block, you will prepare the plant and machinery account and provision for depreciation on plant and machinery account or accumulated depreciation account. Which values? Gross values. Balance brought down 8,40,000. 640 plus 22 lakhs, 8,40,000. Then balance carried down 12 lakhs. This information is here. Don't take the difference. Don't take the difference directly as purchases because there has been a disposal also. What is the disposal value? Machine costing 80,000 was disposed. If machine costing 80,000 was disposed, in the gross value from here I will remove 80,000. I will transfer it to another account called asset disposal account. Okay, sometimes or some of you might have learnt it as a combined entry or doing it capturing profit here itself. That can create confusion. So if you have the information, you directly transfer that to asset disposal account. Okay, 80,000 is gone. So 840 out of 840, 80,000 is gone and the closing balance is 12 lakhs, means the balancing figure 4,40,000 is the purchase value. 4,40,000 is the purchase value. Okay, so that is the first thing. Then in a depreciation account, you have the opening balance, you have the closing balance. Whatever is the depreciation pertaining to the disposed machine, 24,000, this also will transfer to the asset disposal account. And 1,44,000 is the current year depreciation. Now this current year depreciation is relevant because we need to add it back to the net profit. So by preparing these two working notes, we got asset purchase and depreciation for the period. In the asset disposal account, you will bring down the machinery value, bring down the accumulated depreciation, pass this entry for cash collected. This gives the loss on sale, which is the balancing figure. Sir, can we calculate loss on sale directly? Yes, you can calculate. 80,000 minus 24 minus 40 will give you loss on sale. So that also can be done. Now this loss on sale has to be added to the net profit while calculating cash flow. Right? Okay. So how do we do? Net profit. Net profit has given 3,60,000. Add depreciation 144. Okay, then add loss on sale of machinery 16,000. So you get operating profit before working capital changes 420. After that, you just need to see the current asset. You have inventory, trade receivable. Inventory, opening minus closing. So it is 80,000 plus 80,000 plus. Trade receivable 240 to 4 lakhs minus 1,60,000. As I told you, for assets, we will take opening minus closing. For liabilities, we will take closing minus opening. So opening minus closing, 160 minus 160. Same with trade payables, 32,000. This part is done. Okay. Do we have information on taxes paid? We don't have information. Then investment activity, purchase of plant and machinery, investment activity, sale 40, and there is a movement in land also, 6 lakhs to 4,40,000. There is no further information given on that. In that case, we can assume whatever is the reduction in value of land is on account of sale only, and there is no profit or loss on account of sale of land. So the entire value can be taken here. So this is the net amount used in investing activities. Then let us figure out all the items. Capital account 10 lakh became 12,24,000. 10 lakh became 12,24,000. So we need to prepare a capital account and see opening balance was 10 lakhs. closing balance is 12,24,000 and profit is 360, which means this was opening, this was profit, this is closing. So whatever is the balancing figure, these are drawings. Now for companies and all, we have dividends paid. For proprietor, we'll have drawings. So 13,60,000 minus 12,24,000, that is drawings. So drawings becomes 1,36,000. This is financing activity. Drawings 1,36,000. Repayment of loan. So we have done with capital, trade payable is done. Mrs. Jen loan. Opening balance was 2 lakhs, closing balance is 0, means we have repaid the loan. So what about interest? They have not given us information, so we cannot figure out. If interest information is given, we can definitely consider that. So 2 lakhs to 0, 2 lakhs has been repaid, we will capture that. Then loan from bank, 320 has become 4 lakhs, so there is an increase. So we have taken a loan, so 80,000 we will add there. Then assets, land, 6 lakh become 440, sold. Plant and machinery we have already taken, inventory is already taken, trade is already taken. Cash will come here as a reconciling. Okay, so this is how you have to approach. Each balance sheet item you have to see, is there a movement? If there is a movement, have we captured that movement in our answer? If you follow this framework step by step, you will not miss out on a cash flow statement question. Any question in this thing what we solved? We'll do one more question. Okay, and the remaining questions from this stuff you can do it as a practice as a homework actually. That will help you be more confident. Now the next question that we'll be doing, where it has movements in profit and loss account. So I'm just charging the pencil. You have movements in land and building, plant and machinery, and all of that. That is one part. There are movements in equity, reserves, retained earnings. That is the other part. So that part also we have to see, which will actually help us to see how to approach those questions in the examination. This is the next question, a pretty comprehensive one, and I would request you to also revise this is in the last day before you go to the examination. Just have a look at this question, that will actually increase your confidence. From the following balance sheet, prepare cash flow statement by indirect method for the year ended 31st March. Only balance sheet is given, P&L is not given. Now, in these type of questions, this is one very very good question, I would say. As you read the question, you should also see what is the movement happening. So equity share capital 6 lakhs, 5 lakhs, opening balance, closing balance, there is an increase. 10% redeemable preference share capital 2 lakhs has become 0, so there is a decrease. Capital redemption reserve 1 lakh. Now capital redemption reserve happens when you have redemption of preference share capital. Capital reserve, it was 0, it has become 1 lakh. Now how will we get this capital reserve? Either you will transfer it from P&L, or there is a capital item which has been sold, or if there is an amalgamation, or if there is an internal reconstruction. So we have to look at additional information and see how did we get this capital reserve. Then we have general reserve, it was 250, it has come down to 1 lakh, it has actually reduced. And your P&L account 50,000 has become 70. Now if no other accounts were given, if no other accounts had been given here, directly you could have said 50 to 70, that is the profit. But again, is there any dividend component? That also we need to check. Okay. Then you have 9% debentures. It was 0 here, 2 lakhs here. Trade payables, this is working capital changes, this is working capital changes. Provision for taxation we will handle separately. Dividend payable 60 and 90. This also we will see what is there. Then land and building 2 lakhs has become 150. Most likely there is a sale. Plant and machinery 5 lakh has become 765 purchase. Investment 80 has become 50 sale. Inventory working capital change. Trade receivable working capital change, cash and bank separately, voluntary separation payments 65 to 125, there is an increase. Okay, so all of this information has come up. Now we need to start with net profit. To arrive at net profit, we need to close this different accounts, what all movements have happened, and also see if there is any additional information. So many additional information. A piece of land has been sold out for 1,50,000, cost 120. So 2 lakh has become 150, cost was 120, and the balance land was revalued, capital reserve consisted of profit on sale and profit on revaluation. So there is a profit on sale, there is revaluation, and whatever capital reserve you have written here, 1 lakh, that is on account of profit on sale and revaluation, which means profit on sale of land is not credited to P&L. If it is not credited to P&L, we will not do the adjustment of adding it back. Okay. Then, on 1st April of 2020, a plant was sold for 90,000, original cost 70,000, WDV 50,000, and debentures worth 1 lakh were issued at part as part consideration for plant of 4.5 lakhs required. So what has happened? We sold a plant, then we bought a plant. While buying the plant, we gave something in debentures, something in cash. Part of investment 50,000 was sold for 70,000. Investment 80 has become 50. We sold 50. Out of this 80, we have already sold 50. Closing balance is 50. Means there is a fresh purchase. Pre-acquisition dividend received 5,000 was adjusted against cost of investment. So that is a proper treatment. Directors have declared 15% dividend for the current year. Voluntary separation cost 50,000 was adjusted against general reserve. Now this actually is not relevant, but still you don't capture it this way, but still 65,000 is the payment done, that was carried as an asset. Then out of this, some amount has been adjusted against the general reserve and new amounts have been added. Income tax liability for the current year was estimated to be 1,35,000. Okay. Now, first thing, we have to know what is the net profit, and for that we need to prepare multiple different working notes which are related to the P&L account. Okay. So, what is related to P&L account? P&L account, we have relation of general reserve, capital redemption reserve, and capital reserve. Okay, capital reserve. Now, each of these items are related to P&L. Then there is a voluntary separation cost which is also related to general reserve. So that is related to general reserve, right? Then we have CRR, we have capital reserve, voluntary separation cost, right? Now first thing, P&L, and I don't expect such a long question to come in the exam, but what they can do is they can pick up few information from this question and give it as a cash flow problem. Okay, so you have profit and loss account, opening balance, closing balance. So directly plot them. Opening balance, closing balance. Okay. Now, what all adjustments will hit here? We will see one by one. Then we have general reserve, capital redemption reserve. All of this also you plot opening and closing balance. General reserve balance brought down, capital redemption reserve balance brought down, capital reserve balance brought down. Okay. Then see the adjustment. Piece of land was sold, and that said that the balance land was revalued. Capital reserve consisted of profit on sale of land and profit on revaluation. So that is also linked to your capital reserve, where you have captured profit on sale and profit on revaluation. So we need to know where has capital reserve come from. This capital reserve, opening balance was 0, closing balance is 1 lakh. This balance has come from profit on sale and revaluation account. Okay, so this is nothing to do with P&L right now. Then this is okay, this we can do it separately. Directors have declared 15% dividend for the current year. Now what do we do with the dividend for the current year? Dividend, we have equity share capital of 6 lakhs. On that 15% dividend, that is this 90,000 represents 15% of 6 lakhs. Now whatever dividend has been declared, we will debit it to the P&L account, not in the profit and loss account. After profit and loss account has been prepared, we will charge it against the profit and loss account. How much? 90,000. So to dividend payable, 90,000 we have captured. Now one more thing you need to understand is this 90,000 of dividend payable is from the current year. What it also means is this 60,000 has been paid during the current period. This 60,000 has been paid during the current period, right? Then don't directly calculate profit here till the time you close the other ledgers. Okay, so then the next ledger is our general reserve. Opening balance we have taken, closing balance we have taken, and in the voluntary separation cost they have said 50,000 was adjusted against general reserve. So what you will do, you will debit general reserve, you will credit voluntary separation cost. So in the general reserve you have voluntary separation cost 50,000, and in the voluntary separation cost you will have by general reserve 50,000. Okay, so this 50,000 represents voluntary separation cost that has been transferred to general reserve. Then so this part is taken care. Then this is not relevant, this is not relevant. Directors have declared 15%, we have considered. Voluntary separation cost we have considered. Income tax liability we will consider it separately. Then if you see, you have redeemable preference shares, share capital 2 lakhs. This has been redeemed fully, so which is an outflow on your financing activity. And you have capital redemption reserve. So when you redeem preference shares, when you have buyback of shares, you are required to create something called as capital redemption reserve. How will we create this capital redemption reserve? We will create this capital redemption reserve either from P&L or from general reserve. Now because they have not mentioned anything, we can assume that they have used general reserve for its creation. So in the capital redemption account we will have by general reserve 1 lakh, and here to capital redemption reserve 1 lakh. So if you see 2 lakh 50 minus 1 lakh, you have the closing balance of 1 lakh. This ledger is balanced, or this ledger is tallied. So this does not have any impact on the P&L. Sir, can we do directly without preparing this without preparation of general reserve account? Can we assume it will tally automatically? No. The reason is sometimes there may be a balancing figure which you have to transfer from P&L. So don't jump to P&L directly without completing the other ledgers. Okay, then capital redemption reserve opening balance was 0, closing balance is 1 lakh, which is from redemption. So this also is done. Capital reserve account is also done, which means whatever is there in this P&L account has been already covered. So the balancing figure represents net profit for the year. I know this can sound overwhelming sometimes. The logical approach will be plot down all the ledgers, plot opening balance, closing balance, take all the information from adjustments, put it at their respective places, and keep on balancing ledger by ledger. So for example, if this general reserve, okay, just for example, had a balancing figure here, let us say 50,000, just for example. 50,000, this closing balance was something else, this 50,000 was here. Where will I get this 50,000 from? I will get this from P&L. So then you will put here to general reserve 50,000, and that will change your profit earned for the period. So first you will close all the other ledgers, ultimately you will close the profit and loss account ledger. Is this clear? Clear? Great. Right. So then we got net profit for the period 1,10,000. Now this net profit that you have got here is after tax. So you have to clearly write after taxation and add back the provision what is given in the question 1,35,000. You get net profit before taxation 2,45,000. Lot of ledgers have to be prepared. How can we do it faster? Such a long question will not come in the exam. Okay, so if this question has to be tested in the examination, just for a perspective, 5, 6, 7. This should be at least a 25 marks question. If they ask, in the examination, they will not ask it. So then why are we doing it? We are doing it because you need to know how to assimilate information. Okay, what they do, they may remove some adjustments. They may remove some adjustments and they may give it in the examination. So don't worry, you will not get such a long question in the examination. It is only for our revision and being perfect in the particular question. Okay, so we have done that. Then depreciation at 15% has been written off from plant account, but no depreciation has been charged on land and building. Now what we also need to do is we need to prepare land and building account, plant and machinery account, so that we get to know how to prepare or how to calculate the depreciation account. So plant and machinery balance brought down 5 lakhs. Balance brought down 5 lakhs, carried down 765. Balance carried down 765. Then disposal of plant. A plant was sold for 90,000, original cost 70,000, WDV 50,000. Okay. In the previous example, we took 70,000 as disposal. In this example, we will take 50,000 as disposal. The reason being, 50,000 as disposal. The reason being, this is on WDV basis, and this plant and machinery account is also on WDV basis. Because plant and machinery account is on WDV basis, the disposal amount that you will remove will also be on WDV basis. Then depreciation 15% of 9 lakhs. What they have said here on depreciation? This is 765 closing balance. So we need to know how do we get this amount of 9 lakhs, right? Now for that, we have to balance carried down how much? 5 lakhs minus 50,000 is sold, plus the question mentioned that we have purchased for 4,50,000. Question mentioned that we have purchased for 4,50,000. So 5 lakhs minus 50 plus 4,50,000 gives us 9 lakhs. 9 lakhs into 15%, 1,35,000 is the depreciation. That is the first thing. Second thing is 450 whatever we have purchased, the question has mentioned we have issued 1 lakh worth of debentures and 3,50,000 worth of, what do you call, 3,50,000 worth of cash payment, right? So depreciation is 1,35,000. That is what we will use to add back. Gain on sale of plant 40,000. Sir, how to calculate gain on sale of plant? They have given direct information. Sold for 90, WDV 50. So 40,000 you can directly calculate. Gain on sale of investment. This also is the information directly given. Cost 50, sold for 70, which is 20,000. Then that is done. Okay, then we have 9% debentures and we have 2 lakhs worth of debentures. Now, should we take this interest on debentures or not? It is an assumption. You can assume that debentures do not carry interest, they were issued at the end of the period. That could be one assumption. But you have on 1st of April, plant was sold and debentures worth 1 lakh were issued at par as a consideration. So on this 1 lakh, definitely there is 9% debenture interest. And on the remaining 2 lakhs, remaining 1 lakh also, we do not know when they were issued. So you can assume that it is issued at the beginning of the period. So 18,000 is the interest that has to be added back. Okay. Now this, there is a chance that you may miss it in the examination. Don't worry, even if you miss that in the examination, you will maximum lose only 1 mark. You will not lose more than 1 mark. Okay. So after that we get operating profit before working capital changes. Then working capital changes, I have already given you the formula. Opening minus closing. So 95 minus 90, sorry, this is closing, this is opening. 90 minus 95 minus 5. So like that, minus 5, trade receivable, trade payable, liabilities for expenses, you can do it. Right. Then taxes paid 1 lakh. How do we get the taxes paid? Provision for taxation is 60 and 95 and they have not given anything on advance taxes. But they have given income tax liability for the current year is 135. So what we need to do, we need to prepare a provision for taxation account. Opening balance 65, closing balance 95 and 135 is the P&L amount. So 60 plus 135, 195. If closing is 95, we can assume that 1 lakh has been paid. So that is how we got this 1 lakh. Okay. Then voluntary separation payment. This is an extraordinary item. How to calculate that? Opening balance 65 is given. Out of 65, 50,000 has been transferred to general reserve. That is also given. Closing balance 125 is given. So balancing figure is what is paid through bank. So 70,000 is what is paid through. Sorry. Some calculation mistake. 65, 125. This is not 70,000. 175 minus 65, 1,10,000 is the balancing figure. Okay, 1,10,000 is the balancing figure, which is shown as an extraordinary item. Then, for investing activities, simply whatever is the proceeds from sale of land, proceeds from sale of plant, purchase of plant, there is a purchase, sale of investment 70,000 given in the question, dividend received, see pre-acquisition dividend received, whatever amount you have received, that is also your cash flow, so 5,000, then purchase of investment, net cash used in investing activity. Now the key part here is understanding the working notes for each one of them because it is slightly complicated. First, disposal of plant we have already seen, land and building account. Opening balance was 2 lakhs, closing balance is 1,50,000. Out of that, what the question said? The question said that 120 has been sold. Costing 120 has been sold. So, whatever is there in the opening balance, out of that, 1,20,000 has been disposed of. And what is the closing balance? 150. Right? So, if you see 2 lakhs minus 120 minus 150, you get 70,000, which is the revaluation amount. Now, if you want to cross check, 150 was sold for 120, 30,000. This is the profit. And total capital reserve balance is 1 lakh. So 70,000 is the revaluation component. Okay. Then disposal of land, profit of 130. We have already seen how to calculate that. Then in plant and machinery also we have already seen the payment made 350. That will go as a fresh purchase. Proceeds from sale of land 90,000. This is directly given to us. We can derive it here in the first working note. Sold for 90,000, right? Then purchase of plant, we have already done it. Proceeds on sale of investment, again it has directly told us that this is the sale of investment. And purchase of investment, you can prepare the investment account. Opening balance 80,000. Then sold 70,000, gain on sale 20,000, pre-acquisition dividend credited 5,000, the balancing figure 25,000 is your purchase. If you don't want to do it, what you can do is 80,000 50,000 is sold, so we are left with 30,000 and closing balance is 50,000. So 20,000 is purchased, but again 5,000 of pre-acquisition dividend is credited, so 25,000 is the purchase value. Okay, so that is what is an outflow. Then equity shares, 5 lakhs has become 6 lakhs. So 1 lakh we have received from proceeds of equity shares. So 2 lakhs we have redeemed, 1 lakh we have received from fresh issue, 1 lakh is the capital redemption reserve. Debentures, 2 lakhs is the balance change, 1 lakh has been issued against purchase of machinery, so only 1 lakh will consider here. Interest paid 18,000, we have already captured. Dividends paid 60,000, opening balance paid, so this is the thing. Now, how to ensure you have covered everything? After you have prepared the cash flow, If it balances, you have covered everything. That is one way. Or you have to see, did we consider equity shares? Did we consider preference shares? Did we consider CRR, capital reserve, general reserve, P&L? Each item you have to see whether we have considered or not. Now, sir, will we get this question in the exam? You will not get. Don't worry about it. If you are able to solve other questions independently, it is perfect. But I want you to do this before the examination because you have a grip on how to handle different information which is coming from different ledger accounts. That is the only thing which is needed in this particular question. Okay, so we have covered how to prepare the cash flows from using different methods. The remaining question which has not been solved is you can consider it to be your homework and you can do it on your own. It is nothing very difficult. Whatever you learn now, same thing you will learn in CA final also, right? Okay, so there is nothing we need to cover in cash flow statement.